As an investor, we all want to know how to find those stocks that are primed to shoot up in the near future. And today, we'll go over a way to focus in on some of these companies and show how you can do this research as well. If that sounds interesting to you, then you're in the right place, as we'll be digging into some of the numbers behind 5 solid companies like Johnson & Johnson, Comcast, and several others to show you why they're ready to take off in the very near future. To come up with this list of companies, I had several different parameters I used to narrow down the number of possible stocks to invest in down to 5. We'll go over each one of the parameters and explain why they're important to finding stocks that are undervalued and how they can help point out stocks that could be great to invest in. And before we dive in, let me know in the comments the stock or stocks you're seriously considering and why. Also, hit those like and subscribe buttons. It really helps the channel out and lets those YouTube algorithm experts know they got it right showing you this video. So let's go over the parameters I use to really focus in on these companies that are primed to rise in the near future. And stick around because I'll reveal those 5 stocks very soon. The first 2 parameters I used are quite simple and easy to explain. Those would be the number of investment analysts that are covering the company and the analyst consensus for the stock. For this analysis, I wanted companies that had at least 10 investment analysts covering the company, and they had a consensus of buy or strong buy for the stock. The next parameter I used was that the company had at least $25 billion or more in assets. I used this because I wanted to make sure we're looking at companies that are well established and have a nice footprint in their industries. The fourth parameter was the requirement that the stock be within 15% of its 52-week low. Knowing that the stock is near its 52-week low in of itself isn't really that telling and could actually be something to be concerned about. But when combined with the other metrics we'll go over shortly, it can help pinpoint companies that have strong metrics and could be ready to shoot up in price. The fifth parameter or requirement I wanted was for each stock to have a dividend. I did look at stocks that don't currently have a dividend, but honestly, I prefer having dividend-paying stocks when we're talking about long-term investments, which I would consider each of these 5 stocks to be. The final 2 parameters I used are the company's price-to-earnings ratio, or better known as PE ratio, and the price-to-earnings growth ratio, also known as the PEG ratio. The PE ratio is a simple metric that is the stock price divided by the company's earnings per share, or EPS, for the past 12 months. And although the PE ratio can be helpful to look at by itself, it can be even more useful when you compare that to the sector's average PE ratio. And as you'll see with the 5 stocks here shortly, they are all below or very close to the average PE ratio for their sector. In regards to PEG ratio, it's an extended analysis of the PE ratio. A stock's PEG ratio is the stock's PE ratio divided by the growth rate of its earnings. It's an important piece of data to many in the financial industry as it takes a company's earnings growth into account and tends to provide investors with a big picture view of profitability growth compared to the PE ratio. In general, a stock with a PEG ratio at 1 or below typically indicates a stock is underpriced. I'll provide a link in the description of the video to the spreadsheet I used for analysis so you can use it or take a look if you're interested. Now, with the overview and parameters out of the way, onto the part you all want to see, the 5 stocks I think are set for some very good growth in the near future. First up, we have Prologis with the ticker symbol PLD. Prologis is a global leader in real estate logistics, owning and operating high-quality distribution centers across the world. Prologis boasts strong fundamentals with high occupancy rates and a growing demand for logistics space driven by e-commerce growth. PLD currently has an analyst consensus of strong buy across 20 analysts and has assets around $100 billion and currently has a dividend yield of around 3.48%. Their current PE ratio is 30.56, while the sector of industrial REITs has a PE ratio of 29.21. PLD's PE ratio is just slightly higher than the sector's PE ratio, but given that it's currently around 11% away from its 52-week low and that it has a PEG ratio of 0.60, PLD should be a good candidate to invest in and should see stock price growth in the near future. Next up, we have Global Payments Incorporated with the ticker symbol GPN. GPN is a leader in payment technology and software solutions operating worldwide. GPN continues to show strong fundamentals with a robust global networking and increasing demand for digital payments. With a continued shift towards cashless transactions, GPN is poised for long-term growth, making it a compelling buy right now. GPN currently has an analyst consensus of buy across 28 analysts and has assets around $25 billion and currently has a dividend yield just above 1%. Their current PE ratio is 19.88, while their sector of specialty business services has a PE ratio of 25.61. GPN's PE ratio is 22% less than that of their sectors and is only 4% away from their 52-week low. With that information plus their PEG ratio of 0.65, GPN looks to be a very good company to invest in and should see stock price growth very soon. The third stock on the list is CVS Health Corporation with the ticker symbol CVS. CVS is a major player in the healthcare space with a broad range of services from pharmacy retail, like we all know, to health insurance through its Aetna acquisition. With a strategic focus on integrating healthcare services and expanding their digital presence, CVS is well positioned for future growth. CVS currently has an analyst consensus of buy across 21 analysts and has around $75 billion in assets, plus a very nice 4.42% dividend yield. Their current PE ratio is 9.38, while the sector of healthcare plans has a PE ratio of 19.93. CVS's PE ratio is a whopping 53% less than that of their sector, and although their PEG ratio is at the high point of 1.0, CVS looks to go up and could be a smart entry point for investors. CVS is a good example of some of this analysis because I completed my analysis around May 29th, and CVS's stock shot up over 6% on May 31st, almost pushing it out of that requirement of being within 15% of its 52-week low. Our fourth stock on this list is Comcast Corporation with the ticker symbol CMCSA. Comcast is a leading media and technology company providing broadband, cable, and content through its various brands like NBC Universal, and just happens to be my internet provider and TV. Comcast fundamentals are strong with consistent revenue streams from its diversified operation. Their investments in technology and content are likely to pay off in the long run, making Comcast an attractive buy right now. Comcast currently has an analyst consensus of buy across 19 different analysts and has assets over $150 billion and currently has a 3.13% dividend yield. Their current PE ratio is 10.07, while the sector of telecom services has a PE ratio of 22.62. Comcast's PE ratio is surprisingly 55% than that of their sector, and their current PEG ratio is 0.64. The stock price is only 8% away from its 52-week low, and together with metrics from their PE ratio compared to their sector and with a PEG ratio below 1, Comcast could be a nice fit to add to your portfolio. And the final stock on the list, and probably my favorite, is Johnson & Johnson with the ticker symbol J&J. Johnson & Johnson is a giant in the healthcare sector known for its diverse range of products, from pharmaceuticals to medical devices and consumer health products. They've got a solid balance sheet, consistent revenue growth, and a history of paying increasing dividends. They're part of the Dividend Kings group that is made up of companies that have been increasing their dividends for at least 50 years straight. Johnson & Johnson has been increasing their dividend for an unbelievable 62 years straight. J&J currently has an analyst consensus of buy across 14 different analysts and has assets over $350 billion and currently has a nice 3.36% dividend yield. Their current PE ratio is 9.58, while the sector of general drug manufacturers has a PE ratio of 25.90. Johnson & Johnson's PE ratio is shockingly 63% less than that of their sector, and their current PEG ratio is 0.89. Their stock price is only 3% away from its 52-week low, so Johnson & Johnson seems like an incredible company to invest in at this point for long-term investors looking for stability and growth in their portfolio. Well, that's it for this video. We spent some time going over analysis that can be very helpful in finding stocks that are very undervalued from really strong companies that very likely will see upward movement in their stock prices in the very near future. And just as a reminder that with any investment, there's no guarantee of future returns. So if needed, consult with a financial advisor before making any investments if you're unsure what makes sense for you in your investing future. Finally, let me know in the comments your thoughts on any of these companies and if you're invested in them or seriously considering adding them to your portfolio. And don't forget, I'll have a link in the description to the spreadsheet I used for this analysis. And if you like this video, you'll probably be interested in another recent video I did comparing 3 mainstay ETFs in VOO, QQQ, and SCHD. Click right here if you want to see that video. As always, thanks for watching and hanging around to the end. Don't forget to like the video and subscribe so you know when I put out new content focused on your money and how to manage it best with a little bit of comedy thrown in for good measure. See you next time.